An accounting entry of 2.34 tells you everything you need to know about the thin line between nominal cash flow and structural asset erosion. When a major financial institution issues a resounding BOE call on OUE REIT based on future rental upside, retail investors frequently overlook the balance sheet scaffolding holding the entire asset class together. This forensic audit breaks down exactly why the balance sheet matters far more than institutional optimism, especially with this counter facing a major near-term tenant transition that strains its financial buffer. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. As the Singapore market consolidates around record highs, the temptation to reach for high-yielding counters becomes incredibly strong for capital focused entirely on distribution checks. It is precisely during these moments of market optimism that a strict, rule-based forensic screen becomes your most valuable defensive tool. The operational performance might look fine on paper, but the balance sheet scaffolding is what actually keeps your investment safe. We need to look past the headline numbers to see if the cash flow is sustainable or if the asset is slowly eroding from underneath. Let's move straight into the institutional case to see what the market is banking on. When markets are roaring and everything looks green, reaching for an 8 or 9% yield feels like a no-brainer. But optimism is exactly when retail investors get careless and buy into structures they don't fully understand. Our defense is a strict forensic approach that strips away the narrative and looks only at the cold data. If the balance sheet doesn't hold up under a basic stress test, no amount of market optimism will save your capital when things turn south. We are going to examine the exact numbers driving the current analyst hype so you can see the gap for yourself. The institutional thesis issued by DBS on 13 July 26 maintains a highly constructive outlook, reiterating a buy recommendation with a target price of 45 cents against a market price of 36 cents. The core of the analyst's case rests on an operational turnaround and an active asset reletting strategy at OUE Downtown. The building is facing a major near-term transition as its third largest tenant, Deloitte Singapore, prepares to vacate approximately 150,000 square feet of space by the end of 26 to relocate to Orchard Central. This departure introduces an undeniable short-term income overhang that we need to analyze closely. Because Deloitte currently contributes approximately 4.9% of total portfolio revenues and roughly 7% of commercial rental income, their departure is a material event. If the entire space remains vacant throughout 27, the analyst estimates a maximum theoretical downside risk of a 7% drop in full-year DPU. However, the institutional research frames this as a long-term opportunity due to a significant rental reversion gap. Deloitte's historical lease was below $8 per square foot, while prevailing market asking rents sit at around $10, meaning subdivided floors could capture higher rents amid tight CBD supply. Beyond the core office portfolio, the institutional thesis incorporates secondary operational elements that management hopes will drive future value. The planned divestment of Crown Plaza Changi Airport is expected to result in a minor 2% contraction in 27 DPU, which they intend to offset through capital recycling. The report also highlights potential growth vectors, including acquiring an expanded stake in the Salesforce Tower in Sydney, where minority owners look to exit, alongside optimization strategies for One Raffles Place. All of these moving parts lead to a single critical assumption that holds the entire bull case together. Here is the load-bearing assumption that the entire institutional case rests upon. For that 45-cent valuation target to make any sense, management must successfully subdivide and backfill approximately 85% of Deloitte's vacated 150,000 square feet at near-market rents. If they pull it off, it delivers a 0.8% net DPU uplift by 27. But if anything delays this timeline, the narrative cracks. Now let's pivot from what the analysts hope will happen and run our own forensic screen on the actual balance sheet reality today. Our forensic framework audits the structural reality of the balance sheet today. The verified interest coverage ratio stands at a deficient 2.34 times, while net debt to EBITDA is elevated at 8.24 times. If macro conditions shift and net property income drops by 10% due to prolonged vacancy during the subdivision process, this level of interest coverage leaves almost no operational insulation. A review of the interest expense line shows a quarterly sum total of $87 million and an annualized headline figure of $89.4 million, both confirming a significant contraction in our historical buffer. For an income investor, this means the headline yield is structurally fragile. When you place this counter directly alongside prime SGX commercial and industrial peers like CapitaLand Integrated Commercial Trust, CapitaLand Ascendas REIT, and Mapletree Pan Asia Commercial Trust, a clear structural trade-off emerges. OUE REIT displays the lowest interest coverage and the highest leverage multiple among the group, even though its raw gearing ratio remains the lowest at 33.7%. Retail investors often get fooled by low gearing, but low gearing does not equal low risk when your actual debt servicing capacity is this compressed. Let's look at how these metrics stack up against our hard forensic thresholds. Let's run through the financial health checklist. The yield easily passes our minimum hurdle, and the raw gearing of 33.7% is well within our 35% hard ceiling. But the wheels come off at the interest coverage ratio gate, where the 2.34 times metric completely fails our 4.0 times hard floor. The net debt to EBITDA also fails, landing in the yellow flag warning zone at 8.24 times. Occupancy quality remains unaccessible until the upcoming financial disclosures, meaning the balance sheet is already flash flagging two major failures before we even account for the vacancy. Moving into our weighted soft flag assessment, the structural compression of interest coverage under prevailing refinancing rates constitutes a severe operational headwind, earning a major flag weighted at 1.0. On the positive side, sponsor top-ups are absent, meaning there is no artificial net property income engineering, and raw gearing remains stabilized within standard parameters. This brings our weighted soft flag total to 1.0, with key metrics still pending updated global asset disclosures. Let's project what this balance sheet strain means for the forward dividend trajectory. Evaluating the forward durability of distributions requires analyzing the relationship between current cash flows and upcoming leasing vacancies. The base case shows an estimated DPU of 2.9 to 3.3 cents, yielding a high nominal 8 to 9% without any documented sponsor support. But looking forward into 26 and 27, the numbers enter a stressed vacancy model. The trailing metrics are anchored to historical data, but the upcoming transition introduces a structural challenge that most retail investors completely overlook. The core challenge facing the distribution trajectory is a timing mismatch between capital outflows and income collection. Even if the management eventually achieves the projected $10 per square foot rent, the physical execution of dividing 150,000 square feet requires material capital expenditure for configuration, marketing, and tenant fit-outs. During this multi-month period, those floors generate absolutely zero organic revenue. When you combine this vacancy phase with the structural loss of income from the Crown Plaza divestment, the cushion protecting your dividend narrows significantly. When your interest coverage is compressed down to 2.34 times, you have no room for error. If net property income falls temporarily during the asset turnaround, the trust must retain cash to service its debt obligations rather than paying it out to shareholders. This creates immediate downward pressure on the distribution run rate. The toxic combination of vacancy, divestment income loss, and compressed interest coverage results in a structurally fragile dividend that cannot be relied upon for steady income. The analytical divergence between institutional research and our retirement income framework highlights a fundamental difference in core investment objectives. While the analyst focuses on a tactical growth turnaround and sets a target price of 45 cents based on future backfilling, our screen looks at the deficient interest coverage ratio of 2.34 times and flags a zone 4 caution. The institutional lens frames this as a manageable transition with upside, but our framework sees stretched leverage straining the durability of the cash flow you depend on. Institutional analysts operate in an ecosystem driven by capital growth targets and future relative outperformance. Under their framework, a temporary drop in balance sheet safety is entirely acceptable because they view the asset through the lens of a corporate turnaround, assuming operational metrics will eventually heal the leverage. Our forensic approach prioritizes capital preservation and immediate income safety first. For an investor focused on retirement income, an 8% yield with a 2.34 times ICR is an unacceptable structural risk. The portfolio cannot wait for an operational turnaround to repair a balance sheet with no macro buffer. Here's what makes this different from a simple wait-and-see call. The safety margin on this counter has already been consumed, not projected to erode, already gone. Betting on an 85% backfill assumption while your interest coverage sits at 2.34 times isn't patience, it's speculation wearing an income label. And once that capital is committed, unwinding a mistimed REIT position at a loss is far harder than waiting for the H1 results to confirm the picture. In this market, the difference between a sanctuary and a yield trap is decided in a single trading session. By the time this analysis reaches a free subscriber, the entry window has already opened and often closed. Iggy's elite investors don't just get the report earlier, they get it when the numbers still matter. If this forensic breakdown is useful to you, the fastest way to get ahead of the market is to stop waiting for the free version. Iggy's elite investors get 0-day access to every forensic breakdown, the full red zone watchlist, and institutional-grade cheat sheets the moment a setup goes live, for less than the price of a kopi and kaya toast at Raffles Place. Start being the analyst, not the exit liquidity. Monitoring the stability of this counter over the coming quarters requires focusing on 3 specific structural benchmarks. First, the upcoming financial results on 22 July 26 serve as the primary data checkpoint where we must verify the exact annualized interest expense run rate and check for further interest coverage compression. Second, we must track the physical progress of the OUE Downtown reconfigurations, as any delay extends the zero revenue vacancy period. Finally, we must watch the debt maturity profile, because if debt tranches refinance before the space is backfilled, the interest coverage ratio will face renewed pressure. For an income portfolio anchored to long-term sustainability, capital safety must always take precedence over projected yield metrics. An 8% headline yield is highly attractive on paper, but it loses its investment utility if the underlying balance sheet structure is under stress. When leverage metrics enter caution territory, the risk of structural capital adjustments rises significantly. Protecting your retirement capital requires recognizing that income durability is always constrained by balance sheet health. True income safety is found in strong interest coverage, not in forward-looking leasing projections. Our preliminary stance ahead of the upcoming financial results places this counter firmly in Zone 4. Caution: for a retail investor utilizing Central Provident Fund or Supplemental Retirement Scheme capital, a Zone 4 designation indicates that the counter fails our structural safety parameters. Although the asset easily clears our 4.7% minimum yield hurdle, it fails to meet the basic standards required for core retirement income. This stance does not imply a permanent structural rejection of the real estate trust. It indicates that the current combination of compressed interest coverage and elevated leverage introduces unacceptable risks for capital close to drawdown. The analytical parameters applied within this forensic framework are calibrated to support long-term capital preservation under a highly conservative mandate. A reader who possesses a long operational time horizon before requiring active portfolio drawdowns may have a higher risk tolerance for structural turnarounds. Such profiles might view a temporary breach of balance sheet coverage limits as an acceptable trade-off for capturing future rental growth. Similarly, capital allocations derived from a genuine capital surplus outside of core retirement needs can naturally be held to a less restrictive standard, as surplus capital can withstand distribution fluctuations without compromising personal lifestyle stability. This forensic screen simply notes that for core retirement holdings, the current balance sheet structure lacks a sufficient safety margin. To summarize our core findings, an interest coverage ratio of 2.34 times is the core problem, completely failing our 4.0 times hard floor and leaving no macro buffer. Yield alone is not safety, and an 8% headline yield masks deep structural fragility. We must watch the 22 July 26 results as the next critical data checkpoint for all balance sheet metrics. For now, this remains a zone for caution, meaning it is not suitable for core CPF or SRS retirement holdings under its current balance sheet structure. That's the forensic read on OUE REIT, delivered plainly so you can make your own call with your own capital. If this kind of analysis is useful, Iggy's Elite Investors is where you'll find it first. Link in the description below. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.
Unlocking the future of finance. Subscribe for more.